Hi all, and welcome to a new class of Principles of Macroeconomics. Today we are going to discuss the monetary system. In this chapter, we are going to try to find an answer to the following question. First of all, we are going to introduce a very particular asset, which is money. And we are going to discuss which kind of assets actually can be used as money. In particular, we are going to talk about the different functions of money and the different types of money. Then we are going to introduce the authority which is in charge of printing money, that is the Federal Reserve. And in this context, we are going to talk a little bit about the institutional setup that surrounds, if you want, the monetary system. Then we are going to talk about a very interesting interplay between the Federal Reserve, so the central bank, and the commercial banks. In particular, we are going to try to understand how the presence of commercial banks affect the ability of the Federal Reserve to control monetary policy, and in particular, the money supply. Last but not least, we are going to discuss some of the most operational aspects of the money creation. So how the Federal Reserve in practice can create money. So let us start our journey. We start by asking a very basic question, which is, what is money? So what money is and why it's important. First of all, I'm sure that you are all familiar with the concept of money, but something that we want to try to understand is what is the role played by money in our economy. Now, to do that, what we want to do as economists is to think about what would be a world without money. Well, a world without money is a world in which if you want to trade, basically you would require to barter. That means you would require to exchange one good with another. And if I'm not wrong, at least this is the way I studied principle of microeconomics at my time, when you actually go through microeconomics and you want to understand a little bit the way in which agents take economic decisions, including trading, well, there is always an exchange of one good with another good. That is really because most of basically theory that we teach in Principle of Macroeconomics is called the theory of value, and it really involves trades. So we can have exchange between particular goods and money, but most of the time at the beginning you talk about, how basically in this economy Anne and Bob say exchange, I don't know, a bunch of rabbits against a bunch of carrots. So there is always basically an exchange economy where you give one good with respect to another good. And now, if you think about this, an economy without money, then eventually, in order to get any other good, well, you have to exchange with another good. For instance, I am a macroeconomic professor. Let's suppose I want to get an haircut. What should I do? Well, there is no money. So I have basically to go around Boulder and find some hairdresser that is interested in hearing a principle of macro class. So as you can see, the pool of hairdressers that are actually interested is very small. So every transaction becomes very difficult. Every transaction in an economy without money requires what is sometimes called as double coincidence of wants, which is the unlikely occurrence that two people each have a good that the other wants. In our example, getting an haircut in exchange of a principle of macro class. So most people would have to spend time searching for others to trade, which is a huge waste of resources. Can you imagine me going around for Collins, Boulder, Superior, and etc., just to find an hairdresser to get an haircut? By the way, this is not the reason why my hair are growing like that. We are still under a pandemic. But so what I wanted to get from this slide is basically that in a world without money, transactions are very difficult. Why? Because in order to get the good you want, You have basically to find a person that is interested in receiving the good you are able to offer. So this searching becomes unnecessary when we move to a world where there is money, where money is defined as the set of assets that people regularly use in order to purchase goods and services from other people. So let us look at the three functions of money: medium of exchange, unit of account, and store of value. Let us start from maybe the most interesting one of the three, which is the medium of exchange. Particular medium of exchange is an item buyers give to sellers when they want to purchase goods and services. If we were in class now, I would go around and ask, why do you hold money to the students? So it's why in this particular moment you have in your pocket, in your wallet, like $20 or $50. Think really about the piece of paper. Do you care about the piece of paper per se? Do you care about the money per se? No. The reason why you care about money is because with this good called money, this fancy coupon, let's call it like this, you can get goods in exchange. That's the only reason why you care about that. And if you, for just 1 second, you doubt about it, think about the following. Where would you rather live? In an island full of, say, $1 billion of goods and services? Or in an island that just has $1 billion? So, an island full of fancy coupons called dollars of an amount of 1 billion. Well, I think the answer is actually straightforward. You would rather go and live in an island full of goods and services that are worth $1 billion. Unless, of course, you are like Uncle Scrooge that likes to swim in money. So we don't care about money per se, we care about money for its function of medium of exchange. We care about money because we know we can use these fancy coupons in order to get goods and services. In order for money to play the role of a medium of exchange, we really need something. What we need mutually sustaining beliefs that stretch out to infinity. What do I mean by that? Let me use basically the following. So why do we want to hold money? Because we can use as a medium of exchange. So here, what we are trying to understand is people want to hold money to use as a medium of exchange. What do we need for this system to work? Again, we don't care about money. We just get these fancy coupons that, I don't know, they are piece of papers. What is important is that people accept this piece of paper in order to make transactions. So let's suppose that assistant Sam has basically this amount of money and wants a good in exchange assistance with Bob. Say basically the transaction, there is Sam that is giving this money and in exchange gets, I don't know, a pen. Okay? So now Bob accepts this money here. Why Bob accepts this money? Why? Because maybe he wants to get, I don't know, an haircut. So basically wants to go and get an haircut. Oh, I'm terrible at drawing this, but no, actually I'm not so bad. So let's suppose Bob has this hair here. So what he does basically is going to pay, say, Anne, basically these are supposed to be scissors. Okay, so basically it's paying Anne in order to get in exchange an haircut. Anne is going to accept this money if in turn, you can see basically where it's going. Anne accepts this money from Bob because knows that can do a transaction, say, with Jennifer. Okay? At the same time, Jennifer accepts the money from Anne because knows that can make a transaction with, say, Lomi. Okay? So you can see that basically everyone is accepting money from another individual, and the reason is that they know that with these fancy coupons called money, they can make their transaction. But let's suppose that for some reason there is Lomi here, Jennifer here, and let's suppose that for some reason Lomi does not accept money. So let's suppose that Lomi does not want money, and let's suppose that all the rest of the world is like Lomi, do not accept money. What will happen? Well, at this point, if Jennifer knows that the rest of the world does not accept money, she will not accept the money from N. But then there will not be this transaction. Why? Because N knows that Jennifer will not accept her money. And therefore, N will not accept the money from Bob that wanted his haircut. So you can see, since Bob knows that N does not accept the money, because N knows that Jennifer will not accept the money. Why? Because Jennifer knows that there is an entire world like Lomi that does not accept the money, then eventually Bob will not accept the money from Sam. So we are back in a barter economy where the only way in which this transaction can happen is an exchange of one good for another good. So what is very important that you get from here is that in order for money to be accepted, we need that we know that in the future, money will be accepted. So let's suppose that we know that the world is going to end in 2024. Well, suppose that Lomi represent the world in 2024, then in 2023, people will not accept the money. 2022, people will not accept the money. 2021, people will not accept the money, so people will stop accepting the money in 2020. So in order for money to play this role of a medium of exchange, we need these mutually sustaining beliefs to stretch off up to infinity. And this is why I believe we need on our dollar bill to believe in God. In God we trust that this money in the future is going to be accepted. Okay, let us move to the other two functions of money. Another function of money is actually the one of a unit of account, which is basically we use money in order to measure how scarce are resources. You know, in Europe we have the meter, and we use to measure distance. Then you have here the miles to measure distance. Then you have, I don't know, Fahrenheit in order to measure temperature. We have Celsius. It's very confusing. Anyway, all of these are unit of account or yardstick if you want to measure different, basically, aspects. And what is money? Well, money plays the role of a unit of account in order to measure how scarce are resources. A Ferrari basically is a very scarce resource, so it costs a lot of money with respect, say, a Fiat or another normal car. And last but not least, money play a role as a store of value. In particular, people basically can use money in order to transfer purchasing power from today to tomorrow. I don't know if you watched the movie Narcos, where there is Pablo Escobar that actually takes this barrel of money and put it basically in the ground. Well, that's an example of how you can transfer purchasing power from one period to the other. So you can really use money in order to transfer value from today to tomorrow. Now, these two roles, which is the unit of account and store of value, are particularly important. As you have seen in it was chapter 11, where you were basically discussing the cost of living. Basically, we started to mention that there is inflation in the economy. So the level of prices actually go up. And what we are going to learn in this chapter is that is actually due to the fact that the Federal Reserve and in general the central banks keeps, if you want, printing money. Print more and more money. And this is needed in order to satisfy, if you want, all the transactions. As the economy gets bigger and there are more transactions, then you need more money. Otherwise, it's going to be the same fancy coupons called money that had to satisfy a larger amount of transactions. So it's going to be more uncomfortable. So, but because of this, because the Federal Reserve keeps printing money, you will need more money in order to purchase the same amount of good. which is like as if the meter that we use in order to measure distance over time gets depreciated. What does it mean? Basically, it gets larger. Let us now discuss the two kinds of money. On one side, we have commodity money, that is, type of money that takes the form of a commodity, that therefore has an intrinsic value, which means like in terms of scarcity. You can think about these as gold coins or cigarettes in the poor camps. Now, these are types, if you want, of commodity that of money that was used in early stages, like in the Roman Empire and so on and so forth. Now, as the economy developed, basically we moved away from a type of money that has an intrinsic value, and we move instead basically to what is sometimes referred to as fiat money, which is money that doesn't have an intrinsic value and is actually value is given by government decree. The idea is like money is going to be a form of liability of the government that ensures that this money is going to be accepted for transactions. You can think of this as what is the difference between the US dollars versus the money that you get when you play Monopoly. Now, the money that you get when you play Monopoly, this is not accepted for this transaction. There is no government decree that is backing up basically the value of these types of money. So modern economy are economy that are based on fiat money. I believe that the United States and in general, like overall, we abandoned the gold standard. It was in 1933. And if I remember correctly, it was in around 1970s that the United States completely severed the connection between the dollars and the gold. So now we live basically in a world with fiat money, which where the word fiat means basically is a money that has a value by fiat, by government decree. Okay. Oh, this is a very actually interesting slides. Now, I love actually the slides. I think Mankiw had a very nice idea in basically proposing this. And the intention is the following. They are trying basically to understand, to do basically these theoretical experiments. Why gold has been used so much basically as a form of money? Why did it represent the way in which different societies across the entire world were using gold for that? So in order to answer this question, they look at the table, the periodic table of elements, and they say, okay, why did they pick particularly gold? Let me try to see whether I find it. Yep, here. Why did they pick gold and not another of the elements in the Mendeley table? Well, let us basically do this experiment and think about it. Well, you have a bunch of elements. So what you can see is that first of all, you want a type of element that is stable. So in particular, the more you move towards the right, you get more stable elements. So things that existence like on the left here, things that with air takes fire, like lithium with air takes fire. So this could not be used as money, clearly. Then eventually, though, so a very good candidate could be this one on the right, but see, there are gases here. So you cannot use a gas as a form of money. Then eventually there are a bunch of basically elements here in the bottom, and these actually are, possible candidates. The only point is that there are things like plutonium that are radioactive. There are also a lot of these basically elements that basically corrodes. So you don't want things that corrode. So eventually, if you go through all the list, they were mentioning that there are 5 possible candidates, which is rhodium, palladium, platinum, gold, and silver. And let's look at them in turn. So rhodium was discovered too late. It was like discovered in the 1800, so it could have not been a good candidate as a replacement for gold as a form of commodity money. Then eventually there is the palladium, and I think this one comes only from space. So palladium, no, could not be good. Silver, well, I think silver's the issue is that it has been used as money, but it's not as good as gold because it tarnishes. So, it has been as a form of money, but not so good. By the way, money, of course, commodity money has to be a scarce good. You cannot use grass as a form of money because, it's not so scarce. So eventually, the real competition is between platinum and gold. And my understanding is that platinum is very difficult to treat and model it because it requires very high temperature. So the experiment that they want to run is like, if we go back and run the history again, think about Back to the Future. We go back at the initial, basically at the beginning of civilization, and we run the story again. Do we run again a story where we use gold as money? And the answer is that from this table is that possibly is going to be the same. Possibly is inevitable that we are going to end up using gold as a form of money.
Hear that, Mr. Anderson? That is the sound of inevitability.
Wonderful. Now that we are clear what is basically money and what are the functions placed by money, then let us start understanding basically the money supply and the money demand. Now, in this chapter, we are going to focus on the money supply. In the next chapter, we are going to talk about the money demand. So, money supply, basically the question is who's printing money, while money demand is why people want to hold money. We'll partially address this question basically during this before, when we were mentioning that people want to hold money because they want to make transactions. But we're going to explore more in depth in chapter 17. For now, let us focus on the money supply. Who supplies money and how the money creation process works. Money supply. The money supply, or money stock, is the quantity of money that is available in the economy. Importantly, money supply is always equal to the money demand. We are economists. We know that the quantity in equilibrium that we observe, it has to be such that the supply is equal to the demand. So what is the money supply? Is the quantity of money that is available in an economy. Now, what assets should be considered part of the money supply? That's a really new question, which is we have basically two candidates, which are currency. So currency is represented by what I defined before as fancy coupons, which are just these paper bills and coins in the hands of the non-bank public. And then there are demand deposits. So these are the two candidates for the quantity of money available in an economy. So money takes the form of currency and demand deposits. Now, what are the demand deposits? Are the balances that are in the bank accounts that depositor can access on demand by writing a check. Let me try to be precise because I think it's clear for everyone what are these currency, really the dollar bills or the coins if you want, while let us basically clarify what are these demand deposits. Now, let's suppose that this is basically Chase, okay? And here, this is the T representation of the accounting of Chase, where you have on one side the assets of Chase and then the liabilities. Okay? Liabilities is basically what Chase, as a commercial bank, owed to the public, or if you want to his depositors, we're gonna get there. And on his assets, basically what Chase does with these basically liabilities. Where does it invest? As instance, Chase possibly has some loans here, has made some loans to firms, say loans to Google, or he has some mortgages, which are, these are credit for Chase. Chase gives you the money as a mortgage in order to buy the house, and then eventually so as a credit, and this represents your liability, your families. They receive mortgage money in order to buy their houses. Now, how Chase finance these assets? Well, Chase finances these assets using demand deposits. Okay? What are the demand deposits? Well, these are the amount of money that, say, this is me. Okay, this is me. I receive some money from CU Boulder. Remember, I accept money because I know it's going to be accepted in the future to make transaction. CU. I get this money, and what do I do with this money? Well, I'm going to put in the bank. This is just cash that goes directly in my bank. Well, technically, CU directly deposits in basically an account. And this is my account at Chase. And importantly, these are balances that are basically in the bank account, notice here, that I can access whenever I want. If I go assistance to Whole Food to buy some groceries, well, I'm gonna swipe my debit card that automatically goes in my demand deposits, say where I have very few money. But what I was gonna do is gonna take out part of this money in order to make the purchase. Okay, so this amount of these demand deposits, so your current account, basically is considered as money. So the total amount of money supply is equal to the total amount of currency and coins in circulations plus all the demand deposits. Suppose, instance, I am the only one depositing money in this economy. Suppose I deposited $1,000. Then the total money supply in the entire economy is going to be equal to, say, $2 trillion, trillions of US dollar in cash and coins, plus $1,000 as a form of demand deposits. The total amount of money supply is equal to these two numbers, the sum of these two numbers. Is that clear? So this is the money supply. Or well, these are basically two candidates for the money supply. So let us look more precisely how can we measure the money supply. So we already seen there is currency, there is demand deposits, but let us look more in general what constitutes part of the money supply. So the measure of the US money supply have very particular names given by M1 and M2. And the idea is like, this is a very strict definition of money supply, and this is a more broader definition of money supply. So the idea is like, this constitutes all the sets of assets that is part of this M1 definition of money supply. And as part of a stricter, let's say here, narrower definition of money supply, we have currency and demand deposits. We have already talked about that, but also traveler's checks and other checkable deposits. So if you have a traveler check or you have a checkable deposit somewhere else, that is still part of the money supply, in particular the narrow definition of the money supply. And this constitutes, as was 2013, as $2.6 trillion. Okay? And again, we were mentioning that this amount of money increases over time because the Federal Reserve keeps printing money, and the idea it wants to fuel and the new transactions. As the United States become a bigger economy, there are more transactions, more money is needed. But as of 2013, you had 2.6 trillion. So is this the definition of money supply? Are these the only assets that constitute the money supply? Well, that is not the case. There is also a larger and broader definition, if you want, which is given by M1. So M2 is equal by M1 plus a series of other assets. What are these assets? Are saving deposits, this constitutes money, small time deposits, money market mutual funds, and a few minor categories. So what is the criteria for distinguishing between basically M1 and M2? How do they differ? Well, something that is important is that they really differ on their liquidity. M1 and M2 differ on the liquidity of their assets. The idea where liquidity is, by definition, let me write it here, how easily is an asset converted to cash is just how, if you want, less costly is for an asset to be converted to cash in order to make transactions. So let me just give you an example. Currency is already cash, so you can use for making a transaction. Demand deposits, well, you don't even need to convert it. You go at the grocery store, you swipe your debit card, and you can make your transactions. So it's not costly at all. These are super liquid assets. Traveler's checks, again, you write your check, so it's as long as it is accepted, that is basic, and they are accepted. There is super liquid and other checkable deposits. Checkable deposits means you have a prepaid card, you swipe it, the money is already there, and as long as it is accepted, you can use it for making transactions. So these are super liquid assets. M1, super liquid, very liquid. Then here, you basically move to M2, where you have M1. Of course, M2 is bigger. Notice, M2 is 10.8 trillion in 2013, and M1 was 2.6. So M2 was 2.6 trillion of M1 plus all basically these other voices, which are given by saving deposits. Notice, saving deposits are different from demand deposits. Why? Because they earn a little bit of interest, right? You put the money there and you earn some interest. But the bank asks you, in exchange of getting this interest rate, that you have to give an advance notice if you want to move and make basically these deposits available for transactions. Okay? So basically that's, oops, what did I do? Okay? So basically saving deposits, they're not as readily available as basically the demand deposits. Then small time deposits are another example. You can basically put there some deposits, say stay for 1 week, a month, or 3 months, and the longer is basically the period in which basically that you want to use this deposit as a form of savings, the more you get interest rates. But if you want to withdraw this money, well, you have to basically pay a penalty. So they are more costly. Let me go back to my definition here. Basically, saving deposits are more costly in order to be transformed in type of cashable, if you want, assets. Basically, they are more costly in order to make basically transaction. Other example are money market mutual funds, where you basically buy shares of money market mutual funds that invest these in very liquid assets. But again, if you want to withdraw these, maybe it might take 1 day, might take 2 days, there might be minor fees, and etc. So the intuition is that money supply, the idea is that encompasses all the assets that can be used in order to make transactions. The more liquid is an asset, the easier is to make transaction with these assets. The less liquid is an asset, say about, I don't know, a house. Let's suppose the only assets I have is a house. I don't have cash on me. If I want to go to the grocery store, I have to find a buyer of my house, getting everything, getting the money, and then eventually go to the grocery store. So houses, as instance, are very liquid assets. And the money supply basically is a continuum from more liquid assets to less liquid ones, but with some restrictions. So it's going to be M1 and M2 are the most, if you want, common measure of the US money supply. And importantly, when we go ahead in the course, when we talk about money supply, what we have in mind is really these two objects. My advice is for the exam, learn these two lists. Okay? Very good. So let us very quickly solve this clicker question. What is M1, the money supply? So large time deposits, no, this is not. Small time deposits, they belong to M2. Demand deposits, yes, this is M1. Other checkable deposits, oh, that's wonderful. This is M1. Saving deposits, no, this was part of M2. Then traveler's check, wonderful. This is part of M1. Money market mutual funds, no, they are not so readily available, so is M2. Currency is part of M1. Then credit card, oh, credit card. That's very interesting. Don't confuse credit card with debit card. That debit card is basically considered, if you want, you can access your demand deposits with debit card. Or if you want, with checks. But that is different from credit card. Credit card, you are actually getting a credit, a loan from your bank. So it is, if I swipe my credit card at a food, my account balance is not immediately, curtailed with this amount of money. It's not immediately withdrawn that amount of money. No, I'm going to be charged basically next month. So credit card actually is a transfer of resources if you want over time. So it's, this is basically does not constitute M1 money. Michelin categories RAM2, of course not. So we had to sum this guy, this guy, this guy, and this guy. So we had to sum basically these guys. So in total is 150, 155, 205, and 505. So the solution is C. Wonderful. Okay, the money supply that we realize can be measured as M1, M2. There are other definitions, the broader, if you want, when we go from here to here, less liquid. Now we try to understand the role of the Federal Reserve in controlling and creating the money supply. First of all, the central bank, the Federal Reserve, the Fed, is an institution that has two functions. The first one, overseeing the banking system. So basically look at Chase, Citigroup, and so on and so forth. And basically it has to oversee the banking system. Make sure that banks do not take too much risks if you want. And then eventually has another function, which is the one of monetary policy, which is really determining the money supply. So the Federal Reserve in Washington has a role as basically two main functions, the one overseeing the banking system and the one to decide the monetary policy. So in terms of the monetary policy, what do we mean? The setting of the money supply by policymakers in the central bank. So the Federal Reserve is the central bank of the United States that determines the money supply in the United States. Okay, let us look at the structure of the Federal Reserve. The Federal Reserve System consists of the Board of Governors that is located in Washington, D.C., and is composed basically by 7 members that are appointed for 14 years. The most important of the member is the chairman, Jeremy Powell, that if I'm correct, he was nominated actually in 2018, that are appointed for 4 years and can be renewed. And the federal system consists of the Board of Governors and 12 regional Federal Reserves Bank, as instance the Minneapolis Fed. I also believe that Denver has a Fed. So what it does, the Federal Reserve System uses Federal Open Market Committee basically meetings in order to determine the money supply. So the FOMC, the Federal Open Market Committee, decides the monetary policy. So this is very important. How this process works? How do they decide basically the monetary policy? How do they set, if you want, the money supply? Well, they meet every 6 weeks they look at the economy. So whose part is the board of governors that is composed by 7 members, plus where there is also the chairman, that is the most important one, and by the regional Fed that are the presidents. Now, who vote and decides basically about the monetary policy? Well, there is the board of governors for sure, decides basically whether to print money or withdraw money from the system, and 5 regional federal presidents. Now, of these 5 regional federal presidents, the president on the New York Fed is always there. Okay? And the reason is that the New York Fed is a particular Fed. It's one of these 12 regional Feds. So it's part of these 12 regional Feds. But the trade desk, where actually the money supply is introduced or withdrawn from the system, these trade desks are in New York. And because of that, basically, the New York Fed has a particular role. So the president of the New York Fed is basically always present and always vote. The other 4 other regional presidents, instead, they rotate. And they are picked between the 12 regional Fed banks. Wonderful. So we mentioned that the first function of the Federal Reserve is to basically oversee the banking system. And I was mentioning before, basically they want to make sure, the Federal Reserve, that banks do not take too many risks. Now the question is, why? What is the inherent fragility of the banking system that requires the Federal Reserve to basically oversee it? Let us look at that. So the question is, why banks like Chase or Citigroup or Bank of America, you just pick one of these names, have inside as a business, so it's not, it's not the name Chase per se, why in general commercial banks have an inherent fragility in their business, why the business of bankers is inherently fragile. The reason is given by the maturity mismatch. Let us look at this. Commercial banks, basically balance sheets, where you have liabilities, which are the sources of financing, and assets, which are where the bank decides to invest these sources of financing. Basically, there is a maturity mismatch between the assets and the liabilities. And this is what creates inherently a fragility in the banking system. The reason is the following. Banks borrow short-term. Think about my example before. I receive money from my university and I put this cash as demand deposits in Chase. Now, these accounts are super short-term. What does it mean? I put there some money, say $1,000, and then I can decide I want to go to the grocery store and use all these $1,000 to buy and purchase basically all my groceries. But this means that, I don't even give to a heads up to Chase. I just can go swipe the card and this amount of fundings is withdrawn from Chase. But there is a point here. The point is the following, that banks lend long-term. Banks use these demand deposits that can be withdrawn without any notice from the bank. They can use this in order to basically make loans. But loans are inherently very long-term. I just got a mortgage for my house. Well, this mortgage was a 30 years mortgage. Okay? So loans are very long-term. So basically what the banks does, gives the money to the household and the household repays back in 30 years. But at the same time, the bank is financing all of this using very short-term demand deposits, the one I can use in order to make purchases at the grocery store. Can you see? Basically, this side of the assets of the bank is super long-term, while the liabilities are super shorter. Bank finances very long-term investment, very short run. Now let us make an example because maybe this is confusing. Now, let's suppose that, let me just withdraw here, draw basically the balance sheet here. Let's suppose that there are, say, 50 people like me that put $1,000 in the bank in the form of demand deposits. Now, so the right-hand side of the bank is $50,000. These are the money that are available at Chase. Now, Chase can decide to use and give this money to a household, say household H, give 50,000, and every month receives a payment. The household uses this 50,000 basically for, say, purchasing a house. So every month pays back $100. Now notice that in this moment, Chase does not have any more this money. It has a credit, basically, that a credit towards the household that is entitles her to get the house if the household does not pay, but this money has disappeared. So let's suppose that one of these 50 individuals here decide to withdraw $1, goes to Chase and asks to Chase, I want to withdraw $1. Chase will be, I don't have this $1. I gave all these 50,000 basically to this household. It's gonna repay me next month, gonna be $300. I can give you one, but I don't have this basically cash available now. So Chase has to take into account that people are gonna withdraw money. So it's not possibly gonna lend the entire 50,000. Maybe it's gonna lend only 40,000, such that if you get basically a person that needs $1, well, Chase has $10,000 they can use in order to smooth it out. But you can see that the reason why banks are inherently fragile is that people can withdraw money without notice from the bank, and banks lend this money very long term. So maturity mismatch is given by the fact that banks borrow short, but then lend long. So if too many depositors withdraw money, let's suppose at the same time, the bank will not be able to repay all depositors. It's stuck. It's saying, look, I've given all this money to households, firms, etc., and I don't have to repay back. So when this happens, when basically, people start and they want to withdraw their money and there are not enough money, what the bank does, puts all these individuals in a queue. And the first depositors that arrive get their money. The others will not find anything. In our case, let's suppose that Chase has 50,000 demand deposits, lend 40,000. Well, it can satisfy only 10,000 requests of basically cash. Okay? If individuals require, 12,000 for their purchases, what will happen? The bank will become insolvent. It cannot basically pay, and 10,000 will be served, and the other 2,000, so depositors that arrive late, will not get anything. So this generates what is defined as bank runs. If people know that the bank will not repay back the money, that, if you know that you put some demand deposits on your account in your bank, and you know that for some reason you suspect that the bank will not be able to pay back, then eventually I'm gonna start running to the bank. And like me, there will be all my neighbors start running to the bank. And if everyone runs to the bank, then we have a bank run, okay? And because of this, the system, basically, the banking system is extremely fragile, okay? Is subject to risk of bank runs. Here, there is this image that gives you an idea what a bank runs look like. And this is taken from the movie Mary Poppins. If you remember, there is basically the kid that wanted the coin back, and he didn't want to deposit basically this coin in the bank. And when people start hearing that basically the kid didn't have, they didn't want to give to the kid the money back, basically all people started running to the bank. And here you can see that basically they want to close the door of the banks because they cannot satisfy all their customers. So if individuals here will be the demand depositors, if for any reason suspect that bank will not is not basically he will not be able to repay all the requests from the demand depositors, then they will all start running because they want to be the first in the queue to get the money. Okay, so one of the role of the Federal Reserve is to address this fragility, that is due to this mismatching between lending long and borrowing short. So how can the Fed fix this problem? The fractional reserve banking system. And the intuition, let's just give you an idea. Let's suppose you have 50 individuals like me that they put basically each one $1,000 in the bank. So you have $50,000. And let's suppose that each one of us needs basically, I don't know, say $100 for their transaction, $100 for their weekly transactions. Okay, well, what will happen basically every week, the bank will basically be required $5,000 withdrawal. Okay, now this means that the bank can lend $45,000 to households in the form of mortgages, so very liquid, but can keep $5,000 in basically her balance sheets in very liquid assets, okay, such that can use this in order to satisfy the purchases of the 50 individuals, each one withdrawing $100 is $5,000. Okay, now where the banks like Chase can invest, if you want this $5,000 in very liquid assets, well, it's gonna put these assets in the balance sheet of the Federal Reserve. It's gonna put in terms of reserves in the Fed, $5,000. So this will be the liability of the Fed. Okay, so the intuition is basically a Fed can address the fragility by asking banks to keep this $5,000 in the form of reserves in the Fed. Okay, bank reserves. Bank reserves are, again, this is the Federal Reserve. It's not a commercial bank, it's the central bank. This is instead a commercial bank, Chase, put this $5,000 in form of reserve at the Federal Reserve. In a fractional reserve banking system, banks keep a fraction of their deposits as reserves. In this case, the fraction will be $5,000 with respect to the $50,000 deposits that are in her balance sheet, so 10%. And then uses the rest to make loans. We mentioned before, $45,000 in form of mortgages. Okay, the Fed establishes the reserve requirement. What is this percentage? The Fed may require to have 10%, 12%, 15%. So the minimum amount of reserves that banks like Chase must hold against their deposits. Banks may hold more than this amount if they choose. So instead of having 5,000, they say, I want to be sure. So let me double it. Let me keep, say, instead of 5,000, let me put 10,000 in reserves, just to be sure. Okay? And the reserve ratio, R, is given as a fraction of deposit the bank holds as reserves. So, okay, you have Chase, you have the liabilities are given by the demand deposits, you have $50,000, that are the liability of Chase. These are the assets. And the reserve ratio is given by the reserves, say 5,000, divided by the deposits, 50,000. Okay? Reserve divided by this. Let me call it these reserves divided by the reserves, and this ratio is called R, the reserve ratio R. Okay? Denominator is this right-hand side, the demand deposits. Okay? The numerator are the reserves, which are the assets that Chase puts inside the Federal Reserve. So, total reserves as a percentage of total deposited. So, this term here, the reserve ratio, I want you to remember this, is the total reserves as a percentage of the deposits. Okay? Remember what is the reserve ratio. Let's go to the bank T account. So a T account is a simplified accounting statement. I mean, we have been discussing this one even before, that shows the bank assets and liabilities. So the idea here, we have the demand deposits. And here we see that the demand deposits are used, basically say, First National Bank, we mean Chase. Okay? So demand deposits, here will be the one, remember me, my university is paying me a salary and I put as a demand deposits. These demand deposits are used by Chase in order to finance loans, say mortgages, to family for buying houses, or basically are put in terms of reserves at the Federal Reserve. Basically, these are reserves. Here is the Fed, our central bank in Washington. We receive $10. Okay? Bank's liability include deposits, we have seen this, and assets include loans and reserves, and we have seen this. In this example, what is the reserve ratio? So the share of reserves in terms of deposits? Well, is this number here over this number here, which is 10%. Okay? So, how the presence of a fractional reserve banking system affect money supply? So we mentioned before, money supply, it was given by was given by M1. There is another definition which is broader, which could be basically is less or equal than M2. So these are all definitions of money supply. But an example of money supply that we have in M1, we see that we have the currency, and then we have demand deposits. Okay? Now, plus, checkable, we have basically other checkable accounts and so on and so forth. Now, I want you for a second to think about the difference between currency and demand deposits. In particular, answer this question. Suppose there is no banking system. What this money supply would be? In particular, would there exist demand deposits without a banking system? No. The presence of a banking system introduces another form of money, which is the one given by demand deposits. The government just prints this currency, the fancy coupons, the fiat money, the currency and coins. But these demand deposits is just consequence of the banking system. So what we are trying to understand is how the job of the Fed to control the money supply is complicated by the fact that now there are banks that are fragile and have basically make demand deposits, run a business, and have fractional reserves at the Federal Reserve. So how the presence of a banking system affects the ability of the Fed to control the money supply? Let us try to give an answer to this question. Banks and the money supply. an example. So suppose that there are $100 of currency in circulation. Suppose that the money supply is given by, so there are currency plus demand deposits. And here we have zero demand deposits at this stage, just $100. So the total money supply is equal to $100. Okay? To determine the bank impact on the money supply, let us consider basically three cases. Okay? We compute the money supply under three cases. Where there is no banking system, so where the money supply is equal just to currency. Where there is 100% reserve banking system, the idea is like banks are in a very, like banks like Chase, are in a very basically simple business. They receive demand deposits, $100, and they put everything in reserve. They don't make loans. The reserve ratio is equal to reserve divided by deposits, demand deposits. What is it? Is equal to 100 over 100. Is 100% basically of the reserves. And then we consider instead the case of a fractional banking system, where the banks have, say, banks like Chase receive $100 in terms of demand deposits, but use what? Say 5%, $5 in terms of reserves, and $95 in terms of loans. So in this case, the reserve ratio is 5%. Okay, we look basically at this other case. So the goal is to measure money supply under these three different scenarios. Okay, let's get into business. So let us start with the first scenario when there is no banking system. So what is the money supply in this world? Well, if there is no banking system and the public holds $100 of currency, then the money supply is $100 of currency. And actually the intuition is very simple. Again, money supply is equal to currency plus the demand deposits. Now, if there is no banking system, then there are no demand deposits. So the money supply coincides with the fiat money, the $100. Let us now move to the opposite scenario, where we do have a banking system, but it's a very particular banking system. It's a banking system with 100% reserves. So it's a world in which banks do not make any loans. So let us look at basically this particular case. So 100% reserve banking system. So suppose that there are $100 of currency in this economy, and these $100 are deposited in the First National Bank, that again basically will coincide with Chase. So in this case, basically we have 100% reserves. So each dollar of deposits goes inside the reserves. So in this case, we have an R, which is given by reserve over demand deposits, which is equal to 100 over 100, which is 100%. So in this case, what is the money supply? Well, the money supply is given by currency plus demand deposits. Now, in this case, all the basically all the money is held in terms of deposits. So the total money supply is 0 currency and 100 deposits. So in total, the money supply is $100. Now, let us actually make a step back. Let's suppose that, I don't know, in period t equal 1, the money supply is equal to $100 in terms of currency, and these are the deposits, and 0 deposits. So it's a world in which, I don't know, there is the Federal Reserves that injects $100 in this system, say from an helicopter, throw $100. So now there is $100 of currency in this particular economy. So here, these $100 basically are thrown in the economy. So there are $100 in form of currency. Again, let's suppose there were no deposits before. This is just the money supply is equal to $100. 100 of currency plus 0 deposits. Then let's suppose I get this $100. So the first thing I will do in the morning, the day after, I'm going and put this $100 inside the bank. Which one? In this case, Chase. So I don't have anymore the $100 because I'm going to put in the bank. So it's going to be basically me going to the bank and putting inside basically this $100 of cash. And in exchange, I get my debit card. Okay, something that basically is entitled me to swipe and use it. Well, in this case, I don't have any more the $100, so the $100 disappears from the currency, but I have $100 in terms of demand deposits. So what is the total money supply? Still $100. Okay, can you see this? And in particular, the important part is that the Chase, the national bank, does not inject back this money in the economy. Doesn't make any loan. What it does, it just puts this $100 in terms of reserves at the Federal Reserves. So this money never goes back in the system. So there is at the beginning, if you want an helicopter dropped, basically of $100, I get this $100. So now this money has been injected in the economy. I get this $100. I put in a bank. In exchange, I get a credit card. So we pass from t equal to 1, where there was $100 injected in the economy in the terms of cash or currency. And now this is transformed in terms of demand deposits. And eventually the money supply does not change. Okay, why? Because the banks do not make any loans. Okay, now let's see and move to the third example, actually the interesting example. And here, sorry, just to summarize, in a 100% reserve banking system, banks do not affect the size of the money supply. So the presence of banks doesn't affect money supply, is always equal basically to the amount of cash that has been injected by the monetary policy. So let us look at the third case in which instead banks have a fractional basically reserve system. So the idea is that in this world, what will happen is that when you deposit cash in the bank, so say $100, part of this money goes in reserves, so it goes back at the Federal Reserve, so on the balance sheets of the Federal Reserve, but say a fraction of this, say 90, is going to be back into the system in the form of loans. When banks can make loans, things are different. So let us look at money supply in a fractional reserve banking system where banks therefore make loans. So we start basically with, let's suppose that the reserve ratio is 10%. So the idea is like if you have $100 in deposits, you have to deposit at least 10 in terms of reserves. So this one will become 10 in terms of reserves. And then 90 will be in terms of loans. And again, in a 100% reserve system, fractional reserve system, then you will get only 100 in terms of reserves. Now we get basically these loans. Okay, so let me do a step t equal 1. T equal 1, what there is? Money supply is equal basically, let's suppose actually there is an helicopter, basically money that drops basically from an helicopter. This is supposed to be an helicopter. So it drops the money in the form of currency. So you get $100 plus there are 0 deposits at this stage. So basically the money supply is $100. In t equal 2, so the day after, let's suppose I get this money, I go to the bank and I deposit basically my $100 in the bank, and in exchange I get my debit card. Important, not credit card, debit card. We want to swipe the card and directly affects our account. So in this case, the money supply is going to be equal to what? To 0 currency. I don't have any more the currency. The currency is back in the bank and I have $100. So the money supply is still 100. Notice. So at this stage, basically, the monetary policy, the Federal Reserve, use an helicopter to drop $100 in this economy. And at this stage, still the money supply is $100. But then something happens. So This is period T equal 2. Period T equal 2 is basically when there are $100 as deposits, and then basically at this stage they are all in reserves. Now, what happens if banks make loans? Well, something completely new happens at this stage, because what happens is that the banks reintroduce in the economy $90. So what does it mean to make a loan on $90? Where what will happen is that there's going to be a household that receives $90. Okay, they can use this in order to, I don't know, to purchase a television, an iPad, or whatever. Okay, so this is new cash that is in the economy. So at T equals 3, what we will get that the money supply is equal to $90 of cash that are made in terms of loans, plus, of course, still there are these $100 as deposits, so $190. So at T equals 3, when the bank Chase make a loan, something magic happen. Money supply is not anymore 100, it is 190. Okay, and here you can see that in a world in which banks can make loans, but the fact that they can reinject this money in the system, well, money supply has basically, as a miracle, has increased. Okay, so depositors have $100 in deposits, but now borrowers have $90 in terms of currency. Okay, so the total money supply now is 90 plus 100, 190. It passed from being 100 to 190. And then the process is not over, right? Let's suppose now we follow the individual that got these $90. Let's suppose that these $90, let me go back. Oops. Let me go back. Let's suppose that these $90 are taken from N, okay, are borrowed by N. So N received $90 from Chase in order to make some purchase with the promise of repaying it back. So what will happen? Well, basically, let me show you here. And I'm going back to the previous slides in a second. Well, N has $90, okay, in terms of cash. What she does, basically puts this $90 in her bank, which is the Second National Bank. Let's suppose this is Citigroup. Okay? And in exchange, she receives a debit card that allows her to withdraw money from her account. So in this case, well, at the beginning, let us look at all the periods. T equal 1, T equal 2, T equal 3, now we are T equal 4. So T equal 1 was the helicopter drops. What we get $100 in the form of cash currency plus deposits equal the total money supply. Was 0 deposits, these are $100. Then here it was me that what I did, I went to the bank, I deposit in terms of deposits these $100, so the money supply was still $100. Then the miracle happened, the bank, Chase, decided to lend these $90 to N. This was me here, and still I have my $100 in terms of deposits, so $190. Then in T equal 4, we have N going to her bank, so there is 0 cash, and she puts basically $190 in the banking system. So this 190 is given by my $100 in deposits plus her new 90. These new 90 that are in Citigroup, in her, basically in her bank. Somewhere there is also Chase that has instead my $100. 100 plus 90, 190. So still, with the money supply that now is higher, 190, but if also Citigroup makes loans, what happens? Let's suppose that still the fractional reserve is that R is equal to 10%. So the reserves that are due are just basically 10%. Well, the same story will happen. Of these deposits, Citigroup, 9 will put in terms of reserves at the Federal Reserve, but 81 are gonna be lent in the economy, okay? And let's suppose that these $81 that are reintroduced in the system now goes to Sam, okay? At T equals 5, we get what? We get basically that there are $81 that are received by Sam plus $190. So again, the money supply has increased. So now we have $261 in the economy. Sorry, this is 190. I read that, so this is $271 in the economy. So you can see that basically the second borrower deposit basically received this $81. So after receiving this $81, in turn, what it happens? Well, the same story is gonna, Sam is gonna deposit this in his bank, so another bank, I don't know, Bank of America, okay, receives his debit card with respect to this, then Bank of America at the beginning just keeps everything in reserves, then it decides to lend, how much? 90%, if the reserve ratio is 10, so again, new money is introduced in the system. And so you can see you can keep going and going. So from this initial helicopter drop of $100, we have now that basically the money supply is keeping increasing, but at a smaller pace. Remember, the beginning was $100, then 90 were lent, then 81 were lent, now 72.9 are lent, and basically you keep going. The process continues and the money is created with each new loan. Each new loan reintroduces basically cash in the system. At the beginning was $100, was the helicopter drop, then 90 are lent, then 81 are lent, then 72 are lent, until basically this process basically to the limit. If you sum this geometric series, plus, you get at the end $1,000. Okay? So $100 of reserves generates $1,000 of money. Okay? How it is called? This concept is called the money multiplier. Okay? So money supply through the banking system basically is subject to a money multiplier. When you introduce $100 in terms of reserves, this will create what? Basically a higher money supply, much higher than $100. And let's basically compute this formula. Okay? So the money multiplier is the amount of money the banking system generates with each dollar of reserves. So let me go back. The idea is like there is an helicopter drops. You put basically this $100 in the bank. These are associated to $100 in reserves. At the beginning, the bank doesn't lend immediately. They keep in terms of reserves. These $100 in terms of reserves generate how much? If the reserve ratio is 10%, they generate $1,000 money supply. Okay? The money multiplier equals 1 over R. 1 divided by 0.1 times, if you want, the original $100. So 1 divided by 0.1 is equal to 10 times 100 equal 1,000. Okay? 1 divided by R equal basically to this. So y is equal to 1 divided by R. Let us basically try to understand the logic such that we can basically follow through. Okay, so let's suppose that we have $100 in terms of reserves. And let's suppose that the banks had to keep at least R of a ratio which is 0.1 in basically at the Federal Reserve. So $100, basically the beginning, is the original amount of cash, if you wanted, that was in the economy. Then of this, what happens, there's 0.9, so $90, actually, let me use the 100. The beginning you have $100 in terms of cash, you put it in the bank, then 90 of these are lent. Okay, in the economy, is the first loan. Then basically there was N, went to a bank, introduced, let me show here. She went to the bank, $90, 9 went in reserves, and what will happen? Basically 81 were reintroduced in the system. This 81 is equal to this object here. Then this 81 went to Sam. Sam went to his bank and he repeated basically the same job. Introduced 81 in his bank, then 10% of 81, 8.1 went to reserves, and the rest, which was 71.9, went 72.9 was reintroduced in the system. And this one will be 1 minus r to the power of 3. So in total, basically, you get this geometric series, which is the sum of 1 plus, this is equal 1 plus 1 minus r plus 1 minus r squared plus 1 minus r to the power of 3. These are all numbers that are less than 1, less than 1, less than 1. So what is basically the value of this geometric series? Is 1 divided by 1 minus 1 minus r, which is equal 1 over r. Okay? I'm not going to ask you for this calculation in the exam. What you have to remember is just the money multiplier equals 1 over r. I will tell you what is the reserve ratio. Remember, the reserve ratio is equal to the ratio between reserve and demand deposits. And in this case, let's suppose is 0.1, 10%. Okay? So in our example, R was 10%, so the money multiplier was 10, which is this object that I derived here before. So $100 of reserves creates 1,000 of money through the process that we have just described. So let us do this activity in class. So while cleaning your apartment, you realize that you have $50 bill and half-eaten taco. Forget about this. You deposit the bill in your checking account, and the Federal Reserve's requirement is 20% of the deposits. So what is the maximum amount that the money supply could increase? So the idea you have to study basically what is the most that the money supply could increase. Importantly, you already have 50, so I want to know the change with respect to the final money supply minus this 50. And what is the minimum amount that the money supply could increase? Okay, so let us look basically at these two cases. What is the maximum amount that the money supply could increase given a reserve ratio of 20%, given R equal 20%? If R is equal to 20%, we know that the money multiplier is equal to 1 over R is equal to 1 divided by 0.2, which is equal to 5. Okay? So if bank holds no excess reserves, then the money multiplier is equal to 5. Okay? Then the maximum possible increase in the deposits is basically 5 times 50. The initial, basically $50 times 5, the money multiplier. This is basically $250. But the point is that we have to compute the change. So this is the total amount of money supply, how much is generated. But at the beginning, basically, we had this $50. So that we introduced in the system. So the change is given by 250 minus 50 is equal to 200. Okay? Max increase in money supply is equal to 200. What is the minimum? Instead, of course, if basically there was no basically banking system, or if all basically these deposits were not lent, then the maximum increase will be $50 minus $50. So if the bank does not lend this money, then there is no change in the money supply, which is always equal to 50. So the change is going to be equal to 0. Okay, this coincides, if you want, to the case 1 and case 2, which is 100% fractional reserve system, or case 1 in the case of no banks. In this case, the money supply is equal to the amount of cash in the economy. Okay? So if your bank makes no loans, 100% fractional reserve system, then the currency falls by 50, the deposit increases by 50, the money supply does not change. So T equal 1, you find your currency plus deposits. This is equal to the money supply. You find the $50, there is nothing in the demand deposits, so the money supply is 50, equal to, you deposit in your bank, so the currency decreases by 50, the demand deposits increase by 50, but the money supply does not change. Okay, so the difference is 50 minus 50 is equal to 0. There is no change. Okay. We now move to bank leverage and financial crisis. This is very interesting. We try to understand how leverage amplifies profits and losses. In order to understand the role of leverage, we need a more rich balance sheet for our bank, Chase Bank. So let us start basically from the assets. Before we assume that our Chase Bank was able basically to invest in loans and reserves. Here we are going to assume that also the bank can take some risk, say investing assistance in securities. Say among the securities, you can have like stocks in the stock markets if you want to buy some share of Apple, Google, or could be asset-backed securities, which are basically particular securities that give you, entitle you to stripes of claims that arise for basically from mortgages, as instance. So this is just to give you an idea that basically banks can take exposition not only on loans, but also on risky assets, as they could be, as instance, securities in the stock markets. Then, on the other side, let's make our liabilities our source of fundings. Remember, the liabilities are the source of fundings. Okay, while the assets is where you invest those fundings. Now, in general, normal firms, so beside the banks, they can actually basically they raise their funds by issuing debt or by issuing equity. Now, debt, can put it here, are promises of repaying back. The idea is that the bank, what it does, issues a title, this, if you want, bank claim, this debt claim, and in exchange receives some cash from the investors. And if you want, this debt obligation, this title, this debt obligation, is just a promise to repay. There is basically, Chase issue that, and he promised to repay the principal amount, so the amount that has received at the beginning, plus some interest rate. So the important part is that that is a promise to repay. It has to be repaid. Of course, firms can default on their debt, but in principle, there is this implicit promise. But another source of financing, another form of receiving equity, basically of raising fundings, is by issuing equity. Equity are, if you want, securities that entitle to ownership. The idea, if you have a share in a firm in terms of equity, you're entitled in a percentage, depending on how many shares you have, of the flows of dividends that this firm can issue. So can you see the differences that between debt and equity? Debt does not give you ownership, okay? But if you invest in a firm in the form of debt, you know that almost surely, well, it depends by the risk, but there is a promise to be repaid back, okay? Conversely, when you invest in a firm in the terms of equity, what you are doing, you are betting, basically, you have a claim on the future streams of dividends that this firm is going to generate. So nothing is promised here. If the firm does not distribute dividends, the only thing you can do, you can sell your share in the market. Now, banks are very particular. In addition to debt and equity, they basically can raise demand deposits. Okay? So typical firms that just issue equity and debt, but banks also have access to demand deposits that if you want that is very short-term debt. It's not even that because you don't earn any interest, but the idea is like there are all the depositors that can come and withdraw the money or put the money in the bank. Banks are a very particular business. So here our richer balance sheets is given by debt, equity, demand deposits, and on the other side you have reserves, you have loans, and also securities. Why are we introducing these richer balance sheets? The reason is that we want to define basically what is leverage. So for this, we need a notion of debt and equity. Now, sometimes equity is called also as bank capital. Equity or bank capital are just the resource of fundings that a bank raises by issuing equity to its owners. So if you want, is the share of fundings where investors take a stake, a risk on this bank. Okay, so they call it bank capital in corporate finance. I think it's very confusing, but when you hear about bank capital, please do not confuse with the physical capital K that we have seen in chapter 12. This is something that if you want, it will be an investment on the left-hand side. It will be assets. Okay, so now that we have all these pieces, we can define, if you want, basically leverage. By the way, what is the equity? You can see here, equity. Let's suppose you have here debt. Equity. Then these are the assets. What is the definition of equity? Is assets minus debt plus deposits. Okay, so assets minus debt plus demand deposits is equal to equity. Okay, as by our T balance sheet. So what is leverage? How can we define leverage? Well, leverage is the use of borrowed funds in order to supplement existing fundings for investment purposes. So use of borrowed funds are constituted by debt and demand deposits. To supplement existing funds, what are the existing funds? Are the equity. Okay, the resource the bank obtains by issuing equity to its owners. For investment purposes means these are the assets. So the idea is that a bank like Chase can finance its assets, its form of investment, here by using equity, by using, if you want, securities that give ownership, but also debt and demand deposits. So the $65,000 question is how the bank can use debt given by debt and demand deposits in order to leverage its position on the assets. So here, basically just give you a sketch. Let us be basically more formal and showing here what balance sheets will look like. You have deposits and debt. Notice banks in general, they have a lot of demand deposits. The reason why banks have a lot of demand deposits is because really their business is borrowing short term and lending long term, particularly loans. As you can see here, this is very long term. Okay, but also they can have access to security and reserves. In general, debt is more long term. Okay, and capital is given by the ownership shares, if you want. So the idea, if you look at the balance sheets of a bank, you will see a lot of demand deposits, tons of this, a lot of loans in terms of the assets, but also you will see debt and equity. So the question is, how bank can use deposits and debt in order to leverage its capital position? How can we measure this exposure? Well, we can use the leverage ratio. which is given by the ratio of the bank assets. Here the bank assets are given by plus equal to 1,000. So we have $1,000 of bank assets. Of course, we have $1,000 in liabilities, but the question is how many of these $1,000 liabilities are constituted by capital. Okay? So in this example, the leverage ratio, which is the ratio between the bank assets to bank capital is equal to equity, is equal to 1,000, the assets, over 50, the equity, which is equal to 20. So what does it mean? That the bank finances $20 in assets just using $1 from the bank owners and 19 from borrowed money in the form of debt and demand deposits. So the idea, you can see that by having access to basically debt, the firm can use a lot of borrowed money in order to, if you want, take investment positions. It's like if you go, the ideas, to a casino and you, I don't know, you use your $100 and you borrow the other $900. Now the question is the following. If you have a very small stake when you gamble, would you take more or less risk? And of course, the more money you borrow, the less you put a stake on this gambling, the more you want to take risks. And this is basically what is going to amplify profits, but also losses. So let us first see how and formalize how the presence of leverage amplifies the profits. So we start basically from a positive case, where let's suppose that the bank assets, this $1,000, appreciates by 5%. The idea, we start at the beginning that we have $1,000 liabilities, of which basically you had, just to decompose, you had 950, let me actually write it like this, 950 in terms of debt and 50 in terms of equity. Let's suppose that for some reason, basically you really invested very well, and therefore your assets appreciates by 5%. So the idea is like increase by 50. So think about basically your investment position. You just put $50 and now you get $50 more. So your investment has a return of 100%. That's amazing. So although the assets only appreciate by 5%, so pass from $1,000 to $1,050, this is basically almost doubling the owner's equity. So a 5% increase in the assets, which is this 5% growth in the assets, which is given by 50 over 1,000. Well, in terms of change in terms of equity, is a huge. It's $50 out of $50. So your equity doubles. And the reason is that most of these assets were not financed with your equity, were not financed with your stake on basically on the firm, but it was financed by borrowed money. Okay, so leverage allows this incredible, if you want, a return of 100%. Okay, in particular, if you want to understand basically what is the change of assets with respect to equity, well, let us basically do the following. We change, so this is a ratio which is given by change of assets with respect to equity. Let us divide by A and multiply by A. Can you see this cancel out? So we didn't modify anything here. Okay, but what is the change on assets? Well, the change of assets was equal to 5%. Right? We have it here. But then everything is multiplied by this A over E, assets over equity. What is assets over equity? Is the leverage ratio, which, if you remember, was 20. So 5% times the leverage ratio, which is equal to 20, gives you the 100%. A small increase in the assets a tiny increase in the assets, only 5%, finance using borrowed money, deliver huge equity gains. So leverage allows to amplify profits for the owners of the bank. Okay? But here we have seen a case in which assets go up. At the same time, leverage could also amplify losses. And this happens in the case in which instead assets of increasing 5%, let's suppose that they decrease by 5%. So they pass from 950, from 1,000 to 950. So in this case, let us look at the balance sheets of the bank. It started at the beginning from 1,000, and you have 950 of that you had to repay. Remember, you promised you will repay 950. You have 50 of equity, okay? And let's suppose that for some reason, assets now decrease by 5%, by 50, okay? Now your entire equity has been swiped out. Remember, you have to repay the debtor. You cannot choose. You have to repay. You promised to repay. And in particular, if the bank decreases even more than 5%, say 6%, look here. If they decrease by 6%, then eventually you are insolvent. You cannot pay your debt holders. So if the bank is insolvent, then cannot pay back its debt. So what the government can do? Well, the government can avoid that the banks takes too much risk, one. So it can require basically that the bank invests in assets that are safe. But also, and what we are going to see now, it can just require that the bank has capital requirement, which means equity requirement. What does it mean? That the bank keeps a minimum amount of capital, equity, to ensure that the bank will pay off the debtors. Now, if the bank, instead of having $50 of equity, add $100 of equity and $800 of debt, then what we will have is that a $50 drop would then not cause any, actually a $60 drop would then not cause any insolvency. Okay? So what we can say is that the government can require banks to have more equity. Going back to our examples of gambling, the idea is like, if you want to gamble, gamble with your money. Don't gamble with someone else's money. So put a stake such that basically you will make sure that you repay your debt. And indeed, in the financial crisis of 2008-2009, banks that were very leveraged, suffer extreme losses on mortgage loans. The idea is like there was a big drop on the asset sides in terms of the loans, and because of this, basically they became insolvent. Okay, just to give you an idea, to put in perspective, only from 2000 and 2007 we only had 27 banks failures, but during the financial crisis we have 166 bank failures. Okay. The idea there was a drop in the assets and the banks were underwater. If you think about this example, let's suppose that the loss were this amount, say 100, the equity was only 50. So part of the debt was not repaid, default. Okay? So basically what happened, if the banks are basically are in a very risky situation where they think that they could go underwater, what they will do? Well, let's suppose here you have loans and reserves. Well, what they will do, they will reduce the loans and they will put this money in terms of reserves. So this means that the banks loan less money, they put less money in the economy, and they keep instead this money in terms of reserves. This creates a credit crunch, a reduction of credit, less loans. A reduction in the amount of loans. And remember, this creates in turn a reduction in the money supply. There is a money multiplier, if you remember, that what it says is that for any given amount of reserves, if the bank lends, then this one basically creates extra money. Okay, not only the one that are in terms of reserves, also other that is given by the fact that this money circulates. But if for some reason banks decide to increase their reserve ratio, to put more stuff in terms of reserve, more fundings in terms of reserves, then there is a decrease of credit and a decrease of money supply. So to ease the credit crunch, what the Federal Reserve did? Well, started injecting hundreds of billions of dollars worth of bank capital. The idea is that for a short period of time, the government started putting money and pumping money on the equity sides of the banks in the economy. So for a short period of times, what does it mean to basically pumping money in terms of equity? Well, the government became the shareholder of this bank, which means taxpayers became the part owners of many banks. And this policy indeed succeeded and helped restore lending to normal in 2009. So let us now discuss bank runs and the money supply. Now, the risk of bank runs causes money supply to fall. In particular, bank runs is when people, so you depositors, put like this, suspect that their bank are in trouble, means that their asset side risk to suffer some of the losses, so risk to be wiped out, and if there is not enough equity to absorb these losses, well, the depositors are gonna basically suffer a loss. If the depositors suffer a loss, then eventually, or suspect they may suffer a loss, they run on the banks. So under fractional reserve banking system, banks don't have enough reserve to pay off all of the depositors. This is always true, okay? And banks may have to close. So the consequence of the risk of bank runs, banks may make fewer loans. If a bank suspects that basically is gonna have many depositor that wants to ask basically for money, let's suppose this is equity, these are reserves, and these are basically loans. Let's suppose that the bank suspects that all their depositors want to come back and basically to run on the bank and wants the money back. Well, in this case, the bank will put more of their money in reserves just to be able to serve all the depositors. Okay, so banks may make fewer loans. And remember, fewer loans means that basically there is an increase in the reserve ratio. You know, in the limit case where banks does not make any loans, then the reserve ratio is equal to 100% if you want. Okay, is equal basically to 1. An increase in R, of course, reduces the money supply, causes the money supply to fall. So the chain is the following. If the banks fear bank runs, they increase their reserve ratio. By increasing their reserve ratio, they reduce the money multiplier. At the limit, the money supply becomes, basically money multiplier is going to be equal to 1, which is the case of 100% fractional reserve system. Is a world in which banks don't make any loans. And this happens basically during the Great Depression, where a wave of bank runs and bank closing caused money supply to fall by around 30%. Many economists believe this contributed to the severity of the Great Depression. Now, what the government can do in this case? Well, it insures banks and in particular depositors, that they will be paid. Introduce an insurance. The idea is that if depositors do not run on the banks, so if depositors are insured, then they will not run to the banks. And if they do not run to the banks, then the banks will reduce their reserve ratio. And by doing so, they can increase the money supply. So by guaranteeing basically that the demand deposits will be repaid in full, the government avoids the effects of bank runs on the credit system. So let us conclude this chapter by discussing how the Fed can control in practice the money supply. So early we learned that the money supply depends on the bank reserves and via the lending channel on the money multiplier. If you remember, the money multiplier was 1 over R, the reserve ratio, where the reserve ratio was equal to the number of reserves over the deposits. Okay? So a way in which the Federal Reserve can affect the money supply is by affecting either the money multiplier or the bank reserves. So the Fed can change the money supply by changing bank reserves or by changing the money multiplier. Let's see how the Federal Reserve in practice control the money supply. And for this, basically the Federal Reserve has 5 tools, if you want, the furious 5, which are open market operations, discount rate, the term auction facility, change reserve requirements, and change in the interest rates on reserves. These are the type of tools that the Federal Reserve can use in order to affect the money supply. Let us look at them in turn. Let us start with open market operations. Before discussing the open market operation, let me discuss a little bit how the Federal Reserve creates money from a balance sheet point of view. Now, let's suppose that this is the Federal Reserves. These are the liabilities of the Federal Reserves, and these are the assets of the Federal Reserves. Now, we know that among the liability of the Federal Reserve, there is the currency. You know, the dollar bills that you have in your pocket are actually liabilities of the Federal Reserve. It's the Federal Reserves that promise that this currency is backed up by some form of assets. Then, among other liabilities, we have seen that we have reserves. Okay, the one that banks like Chase that have this liability and these assets put inside the Federal Reserve in order to protect, or if you want to make sure that it can accommodate all the liquidity needs that are required by her depositors. Okay? So, as we know, if there is a balance sheet, even if there is a right-hand side, the left-hand side has to be the same. So what are the assets that are bought by the Federal Reserves? Well, most of the times they are government bonds, like T-bills. Of course, we mentioned before that during the financial crisis, actually the Federal Reserves also bought equity of banks. Actually, most of the assets are characterized by T-bills. Let's suppose that the Federal Reserve wants to introduce money in the system. We discussed before one way in which can do that is by using our helicopter drops. Okay, this was our helicopter, so it can issue currency and throw it in the economy. Now, this is just a figure of speech to say that one way in which basically the Federal Reserve can increase the money supply is by basically throwing money from an helicopter. And of course, this is something that actually does not happen in practice. In practice, what you will have is that the Federal Reserve increases the bank's reserves. Okay? How does it do that? Well, by buying T-bills from banks and repaying by giving the banks more reserves. Does that make sense? So the balance sheet here, say, was $3 trillion of currency plus reserves. Now the Federal Reserve decides that wants to introduce new money in the system. How can it do that? Well, by buying T-bills from the banks in exchange of reserves. Say now, this becomes 3 trillions of money supply. So it has issued 0.5 trillion of dollars. And really, as you can see, there has to be an exchange. The idea is like the Federal Reserve wants to issue new money, wants to introduce new money in the system. What it does, introduces money supply in the system, new money in the systems. How? In the form of reserves to a commercial bank, say Chase. Okay, and in exchange, it receives T-bills that go on her asset side. So by this transaction, what it happens is that the Federal Reserve introduces money in the system. This transaction is called open market operation. So this open market operation in particular is given by an open market operation purchase. There is the Fed purchases T-bills from commercial bank in exchange of reserves. It gives the bank reserves and he obtains in exchange T-bills. As you can see, the bank, by doing so, has increased the money supply in the economy. Okay, let us look at the opposite. So this was the case of an increase. If you want, increase in money supply. By the way, where these operations are made? These operations are made in New York, where the Federal Reserve has a trading desk. And thus basically makes this kind of operations. Now, another operation could be instead an open market sale. So open market sales is the opposite. What it does, reduces the money supply. And the operation is the opposite. Instead of having the Fed purchasing, it happens is that the Federal Reserve, sell T-bills to banks. Okay, so here you have banks like Chase, and the banks pay by reducing the reserves. So if we were here, it was the Federal Reserve, you have liability, you have assets, we have here currency, then we have here reserves. Let's suppose that the total amount, here you have T-bills. Here, suppose that this one were the reserves. In total, you have 3.5 trillions of dollars in terms of money supply. Well, what will happen is that via an open market sale, the Federal Reserve, what it does, sells T-bills to the banks and reduces the reserves of the banks. So now it goes back to 3 trillions of dollars in money supply. Okay? This is basically how the Federal Reserve introduce and take out money from the system, at least one of the two. So let us go back to our slides. Okay? So, open market operations. Open market operations are the purchase and sale of US government bonds by the Federal Reserve. In particular, open market purchases introduce money in the system. If the Fed buys a government bond from a bank, it pays by depositing new reserve in the bank reserve account. This was our example where the Federal Reserve passed from 3 trillions to 3.5 trillions introduce money by buying T-bills that enter in the asset side of the Fed, not Chase of the Fed, and in exchange give reserves to the bank from which it buys these T-bills. Okay, this is an example of an increase in the money supply. With more reserves, clearly, also there is an effect from the point of view of the banks. Bank might want to start even making more loans. So this one creates, if you want, also the multiplier mechanism. So if we go back to our example with Chase here, if suppose this is the Fed, this is Chase, let's suppose that the Fed buys T-bills from Chase and increase reserve of Chase. Now Chase, before say had $5,000, now becomes $7,000. So before it had 5,000, now has 7,000. So it has 2,000 more than what she wanted, okay, in terms of reserves. So what it does, it starts by putting 2,000 more in terms of loans. By activating the credit channel, the lending channel, the Chase, what it does, increases the money supply via a multiplier. Okay, the one that we studied before with Ann, Bob, Sam, and so on and so forth. So there is going to be a multiplier effect, an increase in the money supply. On the opposite, if the Federal Reserve wants to reduce the amount of money in the system, what it does, well, it can sell government bonds, okay, to banks. And the bank can pay using the reserve account. So the reserve of the banks go down, okay? Because of this, banks start also lending less, and therefore there is also a multiplier effect that reduces the money supply, okay? These operations of sale of government bond and purchase of government bond happen in New York at the trade desk of the Federal Reserve. Now, the question is, how the Fed decides how much to purchase and how much to lend of this amount of these government bonds. Let us look at it. So how the Fed decides how many bonds to buy or sell? Well, it targets what is called the Fed funds rate. The Fed funds rate is just an interbank lending market interest rate. Interbank means basically banks like Chase and Citigroup lend to each other any given day in this market. As instance, bank with insufficient reserves can borrow from bank with excess reserves, and the Fed funds is just the interest rates on these loans between banks that need reserves or that are in excess of reserves. It's really demand and supply. So the Fed open market committees that, remember, they meet every 6 weeks, use this open market operation in order to target the Fed funds rate, this open market operation at the New York Fed. So changes in the Fed funds cause changes in other rates in the entire economy and actually have a big impact on the entire economy. This is where you might have heard about the Fed funds rate. So let us look at an example. This is the of federal funds. So this is the if you want, in the interbanking market, where banks sell and purchase reserves from each other. Well, what happens is that, let's suppose we start from this equilibrium where this is the quantity that are in the market and this is the Fed funds rate that are traded in the market, and this is the Fed funds rate. If the Fed sells government bonds, which means basically takes out, if you want, a supply of funds from the system, then this causes the supply of funds to be reduced. Okay, there is a reduction in the supply of funds, and this causes the interest rates to increase. Okay, so by affecting these markets, what will happen? The Federal Reserve can affect the money supply. Let us look at other two tools that the Federal Reserve can use in order to affect the money supply. So one way in which the Fed can affect the money supply is by affecting, basically by making loans to the banks, increasing their reserves. Remember, by increasing their reserve, the Fed, what it does, if you want, incentivize the banks to making more loans, and through that, it affects the total money supply in the system. So a traditional method in which the Fed can lend is using and making changes to the discount rate. The idea is this is the interest rate on loans the Fed makes to banks, and that basically affects the amount of reserves that banks borrow. The higher is the interest rate, the less banks want to borrow. The lower is the interest rate, the more banks want to borrow. This can increase their reserves, and by increasing their reserves, they allow the banks to make more loans, and therefore increasing the money supply. This was the traditional method. The new method, instead, does not affect the price, is not targeting the price, so the discount rate on this, so this is a price, but the new method affects the quantity. The idea, the Fed, what it does, chooses the quantity of reserves that decides to lend, and then let the banks bid against each other for these loans. By doing so, Fed lending increases the money supply. Okay, the more banks borrow, the more reserves they have, and therefore the more loans they want to do, increasing the money supply. Let us conclude with the last two instruments of the Furious Five that the Fed can use in order to affect the money supply. Change in the reserve requirement, a change in the interest rate on reserve. So let us start by recalling the definition of the reserve ratio, which is nothing but the ratio of reserves over total number of demand deposits. Okay, and of course we remember that we recall that the reserve ratio is inversely related with the money multiplier. The more banks want to lend, the higher is the money multiplier. And how much banks want to lend depends on how much banks want to put in their reserves. The higher is the reserve ratio, the lower, the less banks want to lend. Okay, so the reserve requirement, Fed regulates the minimum amount of reserves, the minimum. So the Federal Reserve decides the minimum amount of reserves that banks must hold against their deposits. If the Fed reduces the reserve requirement, these are, of course, it increases the money supply. It allows banks to lend more. Okay? So reducing reserve requirements will lower the reserve ratio, and through that increase the money multiplier, and through that the money supply. Now, this was a traditional tool, basically setting the reserve requirements, the reserve ratio. A new tool in 2008 was the introduction on interest rates on reserves. The idea the Fed provided an interest rate on the money that the banks were keeping in the Fed balance sheets. So This, of course, an increase in the interest rate affects negatively the money supply. So take the position of a bank. If I can get an interest rate for free by keeping my money at the Federal Reserves, why should I risk and lend this in the economy where I don't know whether people are going to pay me back or not? So an increase in the interest rate on the reserves reduces the incentives of the banks to lend this money in the system, and therefore reduces the money supply. Now, here at CU Boulder, we have a great economist, Miles Kimball, that is a big proponent of actually negative interest rates on reserves. The idea, instead of paying a positive interest rates on reserve, you should tax the banks to keep the money in terms of reserves. Why? Because by taxing the money, you force the banks to start and keep lending this money in the system such that people can make, such that all of this can boost the economy. So raising the interest rate would increase the reserve ratio and therefore lowers the money multiplier, therefore reducing the money supply. Now, this is in a perfect world. In a perfect world, the Federal Reserve could use these 5 instruments in order to control the money supply by affecting the number of reserves through lending facilities, etc., or the money multiplier. Okay? Now, the issue is that all this system is predicated on the fact that households hold more of their money in the banks. Let's suppose that for some reason, households do not trust the banks and keep everything, all the currency, under their mattresses. Then banks will have fewer deposits. So they will make fewer loans and therefore money supply will fall. So in a system where people don't believe in banks, there is going to be a reduction in the money supply. If you start doubting that the bank will repay you back, you will put less money in the banks, therefore banks will lend less, and therefore there will not be this money multiplier mechanism in place, so the money supply will fall. Similarly, if banks hold more than reserves than what they are required, remember, the Federal Reserve can set the reserve requirements, how many of these reserves are to be put in the Federal Reserve against the deposits. But if for some reason banks want to keep more reserves, then this will mean that they will make fewer loans. And therefore, also this will cause a fall in the money supply. Yet, the Federal Reserve can compensate for household and bank behavior to return fairly precise control over the money supply. So there is always some possibility of the Fed to compensate for this endogenous behavior of households and banks. So to summarize, money serves 3 functions: medium of exchange, unit of account, and store of value. There are 2 types of money that we have seen. Before we were used to commodity money, and more recently we have in our modern system, monetary system, fiat money. Commodity money has an intrinsic value, fiat money does not. The US uses fiat money, which includes currency and various types of bank deposits. So in a fractional reserve banking system, banks can create money in the moment in which they make loan. Bank reserves, therefore, have a multiplier effect on the money supply. Because of this, banks are highly leveraged, and a small change in the values of bank assets can cause large change in the bank capital. So to protect depositors from bank insolvencies, in general, the Federal Reserves require minimal capital requirements. The Federal Reserve is the central bank of the United States, and the Fed is responsible of regulating the monetary system, which means it's responsible of overseeing the banks and is in charge of the monetary policy. So the Fed controls the money supply mainly through open market operations that we have discussed. So the purchase and sales of government bonds against the reserves of the commercial banks. In recent years, the Fed has also set monetary policy by choosing a target for the federal funds rate, using the Fed funds rate, if you want, as a thermometer, in order to discipline its open market operations. And that is it.